Good afternoon and welcome to today's webinar hosted by the National Network of Credit and Financial Professionals. I am here today with Charles Blank, who will be presenting on revenue recognition. A few items to get out of the way before we begin. If you have any questions during the course of the presentation, you can ask them through the questions function on your side panel. We will gather all those questions and save them for a Q&A at the end of the presentation. If you're looking for a copy of the slides to follow along today, they are available through the handout section in your side panel. We will also be sending a copy through email after the presentation is complete. The last item is that we will have a brief survey that pops up after the webinar ends. It only takes about 30 seconds to fill out, but it gives us a lot of great information on how we can continue to make our webinars better for you. Now, Ken Frisco will give you a brief intro of our speaker.
Thanks, Sharon. Okay, I'd like to introduce our speaker and give you his background. Charles Blank is a managing director and advises clients and others within Grant Thornton on the implementation and application of accounting standards under U.S. GAAP and IFRS. He has almost 20 years of experience in both consulting and public accounting. Charles has advised clients on various technical accounting matters, including revenue recognition, business combinations, and accounting for debt and equity transactions. He has also implemented international financial reporting standards at various organizations and has experience across industries, including technology, manufacturing, and media company. He's a licensed CPA in New York and is a CFA charter holder. He has a Bachelor of Arts in Economics from Northwestern University. So I'd like to turn over the webinar to Charles to give today's presentation.
Okay, thanks, Ken. Thanks, Sharon. So today we're going to discuss the new revenue standard, also known as ASC 606. And this is really a significant change in the world of accounting. For those that use financial statements, which I understand much of this group, that's their role as users and perform an analysis on financial statements. Revenue is obviously one of the most significant, if not the most significant area on the financial statements. And today we're going to talk about a new change in how revenue gets recognized in the U.S. and also internationally, but we'll focus on the U.S. We're going to talk about the new standard, give you an introduction to how it impacts, how we expect it to impact financial statements, talk about briefly the process for recognizing revenue, how it may change for certain industries, and then we'll talk about what I think will be very relevant for this group as users, the enhanced disclosures that you're going to see in financial statements, and really where to focus as you see these changes coming through in the work that you do each day. So what's changing here? So what's happened is there's a new revenue standard. So for those that are familiar with U.S. GAAP, companies that need to apply the revenue recognition criteria to recognize revenue for transactions have historically applied a varied amount of different accounting standards that resided within U.S. GAAP. And depending on your industry, there may be specific rules. For instance, in the software space, and then for other industries, there'd be another set of specific rules for recognizing revenue as well. And so because of this complexity, what was being observed over time was that because of all this different revenue recognition guidance, there were situations where economically similar transactions may have been accounted for differently depending on your industry. The Financial Accounting Standards Board, the FASB, decided to take a fresh look at the accounting for revenue recognition. And they did it together with their international counterparts the International Accounting Standards Board. And together, in May 2014, they issued this new standard, which in the U.S. is referred to as ASC, or Accounting Standards Codification 606. And it's going to replace what was ASC 605. So it is, the standard, as you can tell, has been out for a while, but it is only now that we're going to start seeing companies adopt it. For public companies with calendar years, it's going to be first applicable in 2018, and for private companies 1 year later in 2019. And we'll talk for a moment. Unlike most accounting changes, this one will have a significant impact across many aspects of an organization. It won't be just limited to the accounting folks. So, again, what happens? What do we mean with the new standard? What does it mean from a big picture for people who are looking at financial statements? Well, we talked about it, that this is truly an international standard. So not only will U.S. companies be adopting this new standard, but there's an IFRS version that is, for the most part, identical. And so companies throughout the world will be adopting this. It, like we said, it takes away a lot of the prescriptive rule-based guidance for revenue recognition and replaces it with broad principles. And as we'll see as we'll step through this, these broad principles require a significant amount of more use of judgments and estimates. And what that generally, the way they compensate for a lot of this increased use of judgment and estimates in evaluating how much revenue to recognize when, is the standard requires a fair amount more disclosure, which is good for users of the financials because you have a lot more information available to you to understand a company's expected cash flows as they relate to revenue, which historically disclosures around revenue have been somewhat limited. In addition, from a company's perspective, there's a lot to do to adopt the standard. And it's going to impact a fair amount of their processes, systems, and transactions. And as we'll see, it's going to be more broadly based, broad-based impacts across the organization, which folks on the phone may be interacting with, especially on the legal side, certainly with folks that sit in the accounts receivable or tax groups. It's got broad impacts on many across the organization. So here, just as we mentioned, the standard is now going to, this slide just demonstrates all the different industry-specific guidance that existed in the current literature, which will now be replaced by this one single standard. I would just keep in mind, though, that although there'll be one now new principles-based standard for accounting for revenue, there still will be industry-related guidance that is being promulgated by two groups, really basically accounting groups, the Transition Resource Group, or TRG, and the AICPA, which are basically taking a look at the principles and the guidance and putting together position papers to help companies in different industries apply those principles. So in some ways the industry guidance is going away, but in other ways it still remains with us. It's now just in the context of applying the new standard. So just to kind of put the timeline in perspective here, for many companies, it is going to be a kind of race to the finish to adopt the new standard, because as we'll see in a moment, not only will companies be adopting the standard in the year they adopt it, but they're going to need to have disclosures that reflect comparative periods as well. And so, we know a lot of public companies throughout that our firm works with, and from talking with others, that this is kind of if you haven't addressed the standard now for a public company, time is of the essence. So you may start seeing more and more disclosures in companies' financial statements that lead up to the adoption of the new standard, because they're required to provide disclosures that give quantitative and qualitative discussion of what they think the impact of the new standard is going to be. That's for public companies. So what happens when a company adopts the standard? And here we'll focus on public companies, but keep in mind it's the same for private companies. It's just a year later, so all these dates get pushed forward a year later. So the way the standard works is it allows companies to adopt it in using two different methods, either the full retrospective method, which is included at the top, or the modified retrospective method, which is on the bottom. So let me explain both and what that means for users of financial statements. So if a company were to adopt using the full retrospective method, in the first year of adoption, so if it would be effective for January 1st, 2018 for a calendar year company, they would report all of their results under applying the new revenue standard. And then what they would do is they would go back to the prior 2 years, because public companies disclose 3 years of financial statements or income statements, and they would recast their prior financial statements as if they had always applied the new revenue standard. And that it will be very useful for those that are users of financial statements, because it enables you to then compare it to what they had previously reported and to identify what those differences are. And I think, generally speaking, whenever there's an accounting change, the ability to compare what the impact is always helpful for analysis purposes. And then any remaining impact, or rather opening impact, at the beginning, in this example, at the beginning of 2016, would be recorded as a cumulative effect through retained earnings. To the extent a company adopts the modified retrospective method, they would then continue to report under their old GAAP for 2016 and 2017. And then in 2018, they would apply the new standard, but they would provide sufficient disclosure for the 2018 year to enable users of the financial statements to understand what changed when applying the new standard as compared to what the old standard, the results would have been. In this case, when applying the modified retrospective method, the cumulative effect and that impact on retained earnings would be at the beginning of 2018 rather than under the full retrospective method, where that cumulative effect is at the beginning of 2016. Okay, so here we're going to talk about, for a moment, how's the new standard going to potentially impact an organization? And if you see, we've got in each of these boxes, we've got different potential areas where there could be impacts to a company. The most obvious is accounting and finance, where obviously the accounting folks are going to need to put in place new policies and procedures, and where it also may impact the finance folks is obviously budgeting going forward to make sure that they're appropriately considering what revenue recognition is going to look like in the future versus what it looks like today. You'll see sales and operations is another area. Here, because the standard may require folks, or upon applying the new standard, companies may identify that they want to change some of their terms and conditions in contracts where necessary. You're going to see that it will impact the sales folks will potentially have to review their contracts. It may change the way that commission structures work for salespeople. Investor relations, certainly, how they communicate out to the marketplace what the impact is going to be and prepare investors for the change. Certainly, to the extent that a company is adopting a full retrospective versus a modified retrospective adoption, will have an impact on, will be something important that they'll want to communicate to the market so they understand what the impacts are. Disclosures are going to change. We're going to talk about that later on in the webcast. Information technology is probably the biggest, or the area where there's potentially the most significant amount of effort that will be required for a company to adopt the new standard. And so while sometimes the impacts may not be big, the types of information that needs to be collected for purposes of disclosures and for recognition of revenue may change. And so that's the area we find where there's the longest tail needed to really take into account the new information needed for the standard. We talked about employee incentives. Commissions may be impacted for sales folks, other bonuses. On the tax side, certainly tax accounting methods we'll need to consider if there's a change in a revenue recognition policy under U.S. GAAP. And then finally, training for folks across the organization on the new standard, as well as revising controls throughout your organization to take into account new processes for the additional amounts of judgments that are going to need to be applied in coming up with revenue. So with that, we're going to now transition to give you a little bit of an understanding of how the new model works. We'll try not to get too technical here, but I think it will be helpful to be able to at least compare and contrast from a high level how revenue recognition is now going to be evaluated under the new standard versus current practice. So again, we keep referring to these principles. We're going to talk about the 5-step model in a moment, which is based on a fundamental principle for revenue recognition. And I think the biggest thing to realize here is that, as it relates to how will it ultimately impact the timing and the amount of revenue for any sort of transaction, I'll give you some examples where, by industry where there may be some impacts, but at the end of the day, because of the, it's really a facts and circumstances based evaluation where depending on the complexity of one's contracts, it's going to really depend on specific transactions what the impact will be. And that's why, again, like we said, when companies adopt, it will be very useful to be able to compare the old practice versus the new practice, and that's where those disclosures will come in. So the standard itself is based on a single core principle, which on its surface is really straightforward, and I'll just read it here. It says, an entity shall recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled to in exchange for those goods or services. So, on its surface, it's a pretty straightforward principle that says, if you're providing goods and services to a customer, you're going to recognize revenue for whatever consideration you expect to receive. And it's, working your way through to apply this principle, rather, we'll see in a moment that there's going to be the 5-step recognition model. And so just comparing the new model or the new principles to the old guidance, again, in the past, looking at the old guidance, it was a simple concept as well that one would recognize revenue when earned or realized or realizable, which for many meant applying the kind of 4 steps within the SEC guidance, where, in other words, there was persuasive evidence of an arrangement, delivery had occurred, or the services had been rendered, the seller's price to the buyer is fixed and determinable, and collectability is reasonably assured. So those 4 criteria go out the window, and they get replaced with this new 5-step recognition model. Again, we talked about the principles versus the industry-specific guidance, and then the additional disclosures as well. So let's talk here for a moment about what is the 5-step model, and we're going to introduce it on this slide, and then just spend a few minutes going through each of the steps in a little more detail. So sequentially, the way that the model works is initially step one is you identify the contract with a customer. And so that is your starting point to identify really what are the rights and obligations of the parties to provide the goods and services. And that becomes then the basis of analysis to identify performance obligations. And that's a new terminology, and you should certainly be familiar with this now because it's really somewhat similar to the concept of an element in a multiple element arrangement under current revenue guidance. But what it means is you have one contract with a customer, but you may have different promises or items that you're going to deliver under that contract, and they're referred to performance obligations. And each individual performance obligation is going to then be assessed separately to determine how to recognize revenue for each of those. So then the third step says, okay, well, back to my overall contract level, what do I expect the total consideration that I'm going to be entitled to under this contract? And that determination happens at the outset of the contract, and it will be updated later on as to the extent that facts and circumstances change. And we're going to go into some of the judgments that now come into play in determining that transaction price at the beginning of the contract. So step 4 relates to allocating the transaction price to the performance obligation. So now, if you look at step 3, you've identified that total consideration that you're entitled to, and now you're going to allocate that amongst the different performance obligations based on a pro rata allocation method, which we'll talk about in a moment as well. And then finally, after you pass step 4, so now you kind of know how much revenue you're going to recognize or allocate it to each of your performance obligations. In step 5, you finally go ahead and then determine for each of those performance obligations how should revenue be recognized. Should it be recognized either at a point in time, or should it be recognized over time? And we'll talk about how that evaluation is done as well. So let us step through each of the 5 steps, and we'll do this somewhat briefly because I think what will be more useful to this group is to understand a bit more about the disclosures, the additional disclosures that they can expect to see in financial statements as well. But in identifying the contract, I think the slide kind of lays out some of the key criteria that need to be met. And I think that, for this group, really the key takeaways is that you need to have a contract that is obviously lays out clearly the rights and obligations of the parties. It's been approved by the parties, and it's specific enough that you know what is going to be provided under that contract. So, for example, a master services agreement generally wouldn't represent a contract with a customer because it wouldn't lay out what you would see as, for example, the specific items to be purchased or quantities to be purchased that you typically see in a statement of work. So, so a contract is required to move to the next step in the model. And the other kind of threshold that needs to be passed through, which is a little different from today's standard with collectability is reasonably assured, is that based on what you expect to be entitled to under the contract, you have to be basically, it needs to be probable that you think you're going to collect it all. So if you cross that threshold, you have a contract, you move on. If you don't, then you would recognize revenue, and that's the box to the right, is really only after in 3 scenarios. Either you perform what you were supposed to do, and it's been completed, and you got all the consideration you were entitled to, and you don't have to refund it. You terminated the contract, and the consideration, you got the non-refundable consideration, or you stop performing under the contract, and you've collected what you need to collect, and you have no need to perform further. So once you have that contract, we move on to step 2, which is really just identifying those different components of the contract. And the key thing to identify here is, if let's say you've got a contract that says you're going to do a lot of different things, and I think the easiest way to explain this is, let's say you have a building that you're going to build, and it's, you're going to be putting up drywall, you're going to be putting in the plumbing, electricity, etc. The question is, do you have what the standard refers to as a distinct good or service? Is that each of those individual items, or do you combine those together for purposes of seeing if you've got one performance obligation? And the way the standard works is that it says, take a look, is this something that is on its own, something that is what they refer to as distinct? And in this case, maybe the plumbing is distinct. However, you got to look at it all together in the context of the contract. And in this case, what is the customer really expecting to receive? They're not expecting to receive the electrical work and the plumbing, but they all kind of work together and are integrated to create one asset, which in this case, the example would be a building. So if they're highly interdependent and highly interrelated, you really have one performance obligation. So as you can see, there's going to be a fair amount of judgment involved to see within a contract how many performance obligations one has. So let's move on now, which I think this is probably the part that I would focus on for this group, where there's going to be, where I think a lot more of the judgment now comes into play, and where you need to be aware, because obviously, understanding what the cash flows of an entity are as compared to their revenue recognition is something that is of interest in analyzing financial statements. And as we'll see here, is that the standard requires more judgment up front as to what you think that total expectation of what you're going to receive is, and then it gets adjusted along the way. So the transaction price, you'll look off to the right, it's defined as the amount of consideration an entity expects to be entitled to in exchange for transferring goods and services to a customer. And it excludes amounts where you're really acting as an agent, like collecting sales tax. So the one we'll focus on here in determining the transaction price is really variable consideration. And keep in mind there's other things that may impact the transaction price, like the time value of money. So if you've got effectively you get an upfront payment before you provide service, or vice versa, you may have an interest component that stays out of the transaction price. That's another thing to consider. And to the extent that there's payments to customers that are not distinct or not for a good or service, that would be a reduction to the transaction price as well, and that shouldn't be too different from current practice. But let's focus on variable consideration, and I think this slide is one that's just worth spending a minute or two on, just so folks understand what the process a company is going to go through. So what is variable consideration? Well, variable consideration is, if you have, we've established that we have a contract. Well, that contract may, have provisions that allows a customer to be entitled to future discounts or rebates. Perhaps there's price concessions that may be offered by a seller. There may be performance bonuses where certain targets are achieved in the future. The company may be entitled to additional consideration, and likewise penalties may reduce that amount. So although the accounting for all these items, there's specific accounting for many of these items, generally speaking, under current GAAP, many of these items are not truly recognized. So in other words, you don't really recognize a performance bonus until it's probable that you're going to achieve it. And the difference with the current standard is you now take all what you expect to basically receive as variable consideration. At day one under the contract, you make an assessment as to what that is, and that gets incorporated into your transaction price, which is now going to be recognized depending on if you recognize your revenue over time or at a point in time. And so how do you measure the variable consideration? Well, you do it based on either an expected value approach, which in other words, if there's a bunch of different probabilities out there that you think you're going to achieve, for example, a performance bonus, you do that probability weighted method. To the extent maybe there's two outcomes, let's say an 80% chance you'll achieve the bonus and a 20% chance that you won't, you would then go ahead and say, because it's more than likely the most likely outcome is I'm going to get the bonus, you would incorporate that full bonus into your variable consideration. Now, all of this is subject to a constraint, which means that you only recognize it as variable consideration if it's probable that there won't be a significant revenue reversal. So in other words, you'll see there's some criteria here on the bottom right where there may be circumstances where it's possible that you may not be able to estimate this revenue or variable revenue consideration rather, that based on certain factors. So for example, maybe there's some factors outside of the company's ability, to influence that may impact whether they're going to be able to achieve this revenue or not. So if you've got a new drug out there that you're waiting for FDA approval, that would be something that would be out of the control of the company, and they may not be able to estimate, if there's a variable component of a contract. If you don't have sufficient predictive experience in being able to estimate some of these items, that would also potentially mean that you wouldn't estimate them at day one. And also to the extent that there's a large set of potential outcomes or expected values for the item. So I think we're going to have to see in practice to what extent companies apply the constraint, because it will really, ultimately, it's going to determine how much of this variable consideration gets included day one. If you can't estimate the variable consideration, each reporting period, you need to go back and reassess and see if you've come to the point where you are able to estimate it. So throughout the life cycle of a contract, you need to then determine and refine that estimate of variable consideration. So obviously, that is going to have an impact on the revenue that you recognize as well. So once we've got the transaction price, which took into account what I'm expecting to receive under the contract, and you've got the performance obligations as well, you now need to allocate that transaction price to each of the performance obligations. And how that occurs is you basically look at each performance obligation and you take what you believe was going to be the standalone selling price for that if you sold it on its own as opposed to with the other performance obligations as a bundle, and you pro rata will now allocate the revenue, the transaction price, what you expect to receive, to each of those items. So, for example, if I had two performance obligations, and let's say I had I expect to receive a total of $100 for both of those performance obligations, and let's say the standalone selling price for the first one was 70, and the standalone selling price for the second was 60. That would then result in a situation where I would have essentially, based on my standalone selling prices, I'd be expecting $130 or 60% relative to the first performance obligation. So that $100 I would allocate $60 to, and the second one I would allocate the $40 to, or the 40% based on the standalone selling price. So again, another set of estimates here that's used for purposes of allocating what I'm expecting to receive under the contract to each of the performance obligations. So finally, we get to the last step, and here is now a situation, here we get to the point where we actually recognize the revenue. And the way the standard works is that there's three criteria that you have to kind of pass through, the green boxes on the left, which then, if you meet those criteria, you would recognize revenue as you basically provide the goods or the benefit or the goods and services to your customer. And if you don't meet any of those criteria, you would end up recognizing the revenue at one point in time. So the easiest way to think about it is if you're just, if you're a normal ship and bill type of company and you're delivering a widget, you're not going to meet the criteria on the left, and you'll end up just recognizing the revenue when you transfer the risk of loss or transfer control, as the new standard refers to it, to the customer. But if you've got some of these other criteria apply, you're then going to recognize the revenue over a period of time as you provide, or transfer control of those goods and services. So just briefly, the three criteria here are if your customer receives and consumes the benefits as you perform, you're going to recognize the revenue over time. So the easiest example there to understand would be cleaning services, for example. So as you provide those cleaning services, your customer benefits from them directly, and you would recognize that as you provide the services over the contract period. The next box says, does the customer control the asset as it's created or enhanced? In that case, think about a situation where a customer owns a property that you're developing for them. Well, if they have the ability to control the asset as you provide the service to them of building the building, in that case, the revenue would get recognized as the building is constructed as well. So that's similar to what we see today in percentage of completion accounting. And then finally, the last criteria evaluates whether the asset has an alternative use to the entity selling it. And really what we're getting at here is if I'm providing a good or service that's highly customized, for example, to a customer, and as the seller, if I have the right to stop, if I stop producing it, let's say midway through, but I have the right to get payment from the customer plus a reasonable profit margin, I would, as the seller, be able to recognize revenue along the way as I produce that asset. So that may well give rise to a change in practice as well. So what does that mean for a lot of industries? How's that going to change? And as we can tell here, a lot of it's going to be based on running through the 5-step model based on the specific contracts that a customer has. But I'll tell you, certain areas, for example, where we know there could be changes are, for example, software. So software under current GAAP has a very detailed set of guidance around when to measure revenue for the sale of a software license, as well as oftentimes there'll be other items that go with it, like maintenance, maintenance or upgrades. And so under current guidance, there was challenges in recognizing revenue up front for software. You had to meet certain standalone selling price type criteria. Much of those, and if you didn't meet those criteria, you'd be deferring the revenue recognition until you did. And under the current standard, that those sort of restrictions are not as rigid anymore. And so what that means is you could have situations where, generally speaking, you could have a situation where you're able to meet the criteria with this lower bar, and you may see software companies starting to recognize revenue maybe sooner than they did in the past. Things like in the retail and consumer space, where you anticipated or you were going to offer a rebate not at the time of sale, but later on, under the new guidance, if you're anticipating offering that discount, even though you haven't offered it yet, you may well be reflecting that as a reduction of your revenue sooner when you're actually selling the product now rather than when you're offering it later. So a lot of depending on, again, the types of contracts you have, you're going to potentially see these come through as what I would say in general, you may see an acceleration of revenue in many industries. In many, you may see little to no change. But again, I think that's where it's going to be key to look at the disclosures that companies are providing. So now we're going to change gears and talk about what can you expect to see on the disclosure side, and how, what types of new and robust disclosures are there going to be out there. Generally speaking, the standard provides for, because it acknowledges the fact that there is a significant amount more judgment that preparers of financial statements are going to use in coming up with their revenue recognition, the standard provides for a fair amount more disclosure. And it has a simple disclosure objective that it says the objective of the disclosure requirements is for an entity to disclose sufficient information to enable users of financial statements to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. And so while the standard does provide a fair amount of specific things they want you to disclose, it is somewhat flexible in the form of what that disclosure looks like. So keep in mind as we step through this, what's going to actually appear in financial statements for any given company may look a little different from others, but the principles of what they're supposed to disclose, which is really to help people evaluate the future cash flows under a company, is always going to be the theme that they need to stick to. And so we don't think we're going to see as much of the boilerplate disclosure guidance for revenue that you tend to see these days. So we'll talk about each of these areas a little bit, but I think what to expect from a big picture is that there's going to be a fair amount more disaggregated revenue disclosure. So beyond what you see today in segment disclosures, it's going to go down to a more granular level, potentially seeing more disclosures around different types of products and services that a company offers. We're also going to talk about information about contract balances. So that really is, what you see today as a accounts receivable on a balance sheet, you're now going to see additional items or contract assets, which are going to be new to, or going to be a new concept. And then we'll talk about, generally speaking, what additional disclosures there are going to be about performance obligations. So either where you've recognized a performance obligation, and when you recognize a performance obligation, that means you've recognized revenue, or where you haven't recognized a performance obligation because you haven't yet transferred control of that good or service at the end of the year. What types of disclosures will be there to help people understand how that revenue will be recognized in the future. So we just mentioned the concept of contract balances, and so let's spend a moment here and talk about what does that mean for a company on its balance sheet. So obviously the revenue piece is going to change, is going to be, we now have the concept of performance obligations and revenue, but what does that mean on the balance sheet? So you're going to still see receivables on the balance sheet, which is really, if you look at the flow chart on the left, it says a receivable is going to represent when you have the right to consideration for goods or services that you've transferred to a customer. So you've transferred the goods or services to a customer, and under your contract, you've got the unconditional right to receive that consideration. So that means the time, basically just through the passing of time, you have the right to bill and receive that amount. If that's not the case, in other words, that maybe you've transferred what you need to, you've transferred the goods or services, but the contract doesn't necessarily say you have the right to bill, you're going to see something that appears similar to a receivable, but it's called a contract asset. So it, again, will be similar in the context that it represents amounts you expect to receive under a contract, but it's going to be called either a contract asset or something else. There is some discretion as to what you call it. but it's not going to be called a receivable. So keep in mind that is going to probably be a bit of a change on the balance sheet when looking at really what are the amounts that are due from customers, receivable versus contract asset. On the liability side, you're going to see, again, to the extent that you've got an obligation to transfer the goods or services to the customer, but and you've received the consideration, or you do the consideration, similar to a deferred revenue, where you now have this obligation to provide the goods or service, you're going to see something called a contract liability or something similar to that. So, again, that's going to be really on the books. It's going to represent essentially where you have that revenue that you're going to recognize in the future, and you've received or due contractually consideration. So a few new concepts there. We talked about the disclosure objectives, so let's move on to the concept of disaggregation of revenue, and I'll show you an example here which will hopefully help. But I think at the end of the day, the important thing to remind or to be aware of and keep in mind as we step through this, generally speaking, non-public companies will not be required to disclose the same amount of detail as public companies. And the way that the standard works is it really allows for a more qualitative discussion of disclosures as opposed to the quantitative. We're not going to go through the distinctions here, just given the time that we have left, and we just have a few minutes left. But I just want you to be aware of that when private companies adopt the standard in 2019, you're not going to see the same level of disclosure that you've seen for public companies. And so, again, the broad concept here as it relates to disaggregation or the different types of revenue streams that one needs to disclose is going to be based on depicting how the nature, amount, time, and uncertainty of revenue and cash flows are affected by economic factors. And you really need to provide, the way the standard works is you need to provide sufficient information to enable users of the financials to be able to evaluate that. And that obviously is going to be based on a fair amount of judgment. So what are the types of items that a company, or the aggregated levels of disclosure that we expect companies to be considering here? Well, here are the kind of different areas where you may see companies disclosing different revenue streams. The types of goods or service, maybe major product lines, geographical region by country, the market or type of customer. Is it a government? Is it a non-government customer? Type of contract, fixed price, time and materials, maybe by contract duration, short-term versus long-term contracts, the timing for the transfer of the goods and services, is it point in time, point over time, and the sales channels. Are they sold directly to consumers, or are they sold through distributors? So those are the types of categories. None of this is prescriptive, but it's the sorts of things that a company will need to consider. How do they enable the users of the financial statements to understand their different revenue streams? And again, this is what I think will be one of the most helpful things to those that are users of financial statements. And so here is an example of just what we may see for disclosures for a company. And here, I think as you'll see in this example, you got two segments. You got consumer products, you got transportation, and in this case, for purposes of disclosure, the company disclosed their primary geographical markets, their major product lines, and the timing of the revenue recognition at the bottom. So it's kind of slicing it up into three different areas, and the hope is companies will really adhere to the standard and give you that additional disclosure to evaluate the time and uncertainty of cash flows. And then just as it relates to contract balances, I think the key takeaway here is at the bottom. And so you're going to see more reconciliations of amounts on the balance sheet to understand receivables, contract assets, and liabilities, how they roll forward during the period. The revenue, the change in estimates that occur each reporting period, to be able to really see the activity and the estimates that are used within them. But I think the key here is at the bottom is that they're going to have to talk about the timing of payment, how it relates to basically the timing of revenue recognition, and I think that's going to be useful information to help understand basically that if there's significant timing differences between the recognition of revenue and the cash flows. So as we kind of step through to the end here, performance obligations, again, I think there's going to be a lot of disclosure, additional disclosure to enable users of the financial statements to understand, how transaction prices have been allocated to the different performance obligations over time, how the entity expects to recognize revenue from performance obligations over time. So to the extent revenue hasn't been recognized, there's going to be required disclosure, which is going to indicate, do they expect to recognize the revenue over 1 year, 2 years, which will help really then understand how, again, understanding timing between differences in cash flows and revenue recognition. So, I guess just to recap here, we've gone through a lot of material in the last hour, and if we were to kind of talk about the key takeaways for folks that are using financial statements, I'd probably characterize it as follows. So one is there's obviously going to be a lot more judgment involved in how companies recognize revenue. The good news is there'll be more disclosure to be able to then understand the judgments that a company's made, and there'll be more disclosure to understand the timing of cash flows and the uncertainty of those cash flows related to revenue as well. I would key in, and as you look at companies, look at their disclosures leading up to this year, especially if you look at public companies. Take a look at their disclosures and how they evolve over time as they lead up to the adoption date, and how they disclose what the impact of the standard is going to be, because it will give you some good insight as to what may change. And then once a company adopts the standard, really to be able to look at those transition disclosures, because that's going to be the best information you have to analyze. Did they accelerate revenue recognition? What types of new judgments are incorporated in there? How does it differ from the cash flows? And just to, as the kind of last two slides we had here, I think what we did was just put together some, what should be very familiar to this group, just very common financial ratios. And I think the one thing I would observe here is that the impact of the standard will probably impact almost all of these ratios, because be it if you're changing either the amount you're recognizing on the balance sheet or in the income statement, almost any common financial ratio, and we've got 2 pages of them, are going to be impacted. So with that, that kind of rounds out the presentation. I'll turn it back to Sharon and Ken.
Okay, Charles, thank you. There is one question from Tim, and I'm going to read that question. He wrote, "We are a privately held company and would like to know when transshipping our product on an ex-works basis to a third-party warehouse, which may be warehouse for several months prior to shipping it to our ultimate customer. What are the differences, if any, between GAAP and IFRS regarding recognizing this revenue?
Yeah, so thanks, Sharon. So I think, it sounds like the question relates to a company that uses a third-party warehouse. And in those situations, what's going to need to be done under both U.S. GAAP and IFRS under the new standard is really shouldn't be different. The focus is really going to be on when do you transfer control of those goods and services. And to the extent that the company is still responsible for the risk of loss when it's held at the third-party warehouse, in most cases you would typically, if that's the case, you wouldn't recognize revenue until you basically transfer control of the goods and services, or goods in this case, which would be when you ship it to the end customer. And that should be consistent to both U.S. GAAP and IFRS under the new standard.
Okay, and it has a second part to this question, and he did write, by the way, the third party is warehousing.
So just to be clear there, I think what I'm hearing is it's a third-party warehouse, and again, I think the response I had was it really depends who's responsible for those, basically the risk of loss when it's held at the third-party warehouse. And if it's the company, which in many cases it typically is, right? The risk of loss or control hasn't transferred until it leaves that facility. And again, then you'd look at the shipping terms to evaluate specifically at what point in time the control transfers to the customer.
Okay. We don't have any other questions at this time. With that, we are going to close today's webinar. I would like to thank Charles Blank for taking the time to present to our group today, and thank all of today's attendees for taking time out of their day to join us. Thank you all again, and we look forward to seeing you at our next webinar. Thank you, Charles. The webinar now is going to end. Thank everyone for joining us. Bye-bye.
Bye-bye.
Thank you.